Hello everyone. The book on the slide, Value Investing and Behavioral Finance by Parag Parikso, is one of the most honest books ever written about why investors fail. Not because markets are complex, not because they lack information, but because they lack self-awareness. Today, our team is going to walk you through the core ideas from this book, and we assure you at least one of these concepts will change the way you think about money. Before we begin, a quick introduction to our team. I, Priyanka Lamba, alongside me today are Mr. Riyansh Parekh, Vidanshu Patel, Mr. Neil Solapurwala, Mr. Sneh Shah, and Mr. Sabir Sheikh. We have divided the book across different learnings and each of us covering a distinct theme. I'll be taking you to the first two learnings, so let's get into it. So, Parag Parikh sir opens this book with a bold claim, and it's right there on your screen. Failure is as predictable as success because it is a strength of the character. It separates the winner from the loser. Not intelligence, not information, not strategy, but a character. And he begins by describing what he calls default human nature, the factory settings we all come with. Six traits, that is lazy, greedy, ambitious, selfish, ignorant, and vain. Six desires: security, comfort, leisure, love, respect, and fulfillment. Now, here's the uncomfortable truth, that is 90% of our actions are habit, which means most investors are not making decisions, they are running programs they have installed years ago. So this is where it becomes more dangerous in investing, that is predictability of failure. Pariksa introduces what he calls the E factor, the expedient factor. Human beings are wired to seek what is fast and easy now over what is hard and necessary. Fun over discipline, short-term gain over long-term wealth. And the result, short-term gain, long-term pain every single time. But the nature has its own law. He calls it the law of the farm. But you cannot plant a seed today and harvest tomorrow. You cannot cram a season. A tree takes years and so does wealth. Mr. Buffett understood this. Mr. Lynch understood this. They beat the E factor not because they were smarter, but because they were patient enough. And that is the mindset of success. EQ over IQ, emotional intelligence over raw smarts, the discipline to do what you should even when it feels wrong. Failure in investing is not a surprise, it's a choice. The question is whether you'll make it consciously. Now we move to the price of the patience. Let me start with two lines at the top of this slide, that is because everything I'm about to say flows from these two lines. The myth, equities are inherently riskier than fixed income, and the reality, businesses are stable, risk is irrational crowd behavior. That is the entire learning in two sentences. But let me show you why it's true. Look at the first pillar, that is fundamental. Parak Parikh sir studied the BSE Sensex from 1991 to 2007, that is almost 16 years. And what he found about corporate earning was remarkable. EPS, that is earning per share, compounded at roughly 16% every single year. Consistent, business driven, completely unaffected by the market mood. This is the fundamental return, the engine running quietly underneath all the noises. Pillar 2, that is speculative. But now look at the Sensex chart on the right hand side. Look at the orange line. That is what the market actually returned year to year. 1992-93, 267%. 1993-94, minus 47%. The businesses did not triple overnight. They did not collapse the next year. What changed was the sentiment, the P ratio swinging from extreme optimism to extreme pessimism and back again. The orange line is not a market chart. That orange line is a chart of human emotion. And that brings us to the most important concept, that is the acquisition price. The price you pay determines your return, not the quality of the business alone. If you buy at high PE during optimism when everyone is excited, even if the company grows, the P contraction will eat your returns. You were right about the business and you still lost your money. But if you buy at the low PE rate during pessimism when nobody wants it, two things happen simultaneously. First, the company's earning continue to grow, that's the fundamental return. And second, when the market recovers, the PE expands, that's the speculative return. Both forces working in your favor at the same time. Parak Parekh sir calls this the double whammy effect, and here's the brutal reality that the slides capture in one number. Only 10% of the investors are disciplined enough to execute this. The other 90%, they're doing what Parekh sir calls the physical way: chasing screens, following news, tracking rumors, moving with the herd, working hard, and earning less. As he writes, and I want you to remember this line, the ability to take a stand contrary to that hold by the crowd is an indispensable tool. Not a nice one to have, but an indispensable tool. Thus, the real edge is not information, it is patience. With that, I'll hand it over to Mr. Ryansh Pai. Thank you.
Hello. So let's start with what is behavioral finance. Behavioral finance is a way of understanding how people's emotion and psychology affects their financial decision. It means people don't always make their money related decision based on logic. They sometimes make their decision based on overconfidence, greed, fear, habits, belief, and many more traits. Now, let's understand what is asset allocation. Asset allocation is a primary step every investor should take before investing in any asset class. Every asset class has its own risk as well as reward. Now, let's discuss risk aversion. Risk aversion prioritizes capital preservation. Investors fear losses and prefer safer options. Now, there's a famous school of thought that value stocks outperform both growth stock as well as popular stock market indices over a long run. Let's discuss what is value investing and growth investing. First, value investing. Value investing is also known as fundamental approach. Value investing requires fundamental analysis. Developing a set of investment principle requires a lot of hard work and patience. If value investing is so successful, why not everyone is just following value investing? The behavioral obstacle for pursuing value investing are error of judgment, herd bias, loss aversion, and many more. Now, let's talk about growth investing. Growth investing is also known as dream stock approach. Growth stock are meaningless as one can only find growth stock in retrospection. It is merely a stock that went up very high. Example are infrastructure stocks, reality stocks, power stocks, financial services stocks, IT stocks, and many more. The behavioral traits of growth investing are chasing fads and fancies, rationalization, availability heuristic, and many more. Now let's talk about next slide. Contrarian investing. Who are contrarian investors? A contrarian investor can be defined as an investor who bets against the conventional wisdom, but only when the crowd opinion appears to be wrong. First, let's talk about the barriers. Why going against the brain is so difficult? There are basically two barriers: psychological constraints and organizational constraints. Let's talk about psychological constraints first. Our mind regularly pushes us to follow what is safe and accepted by others. We stop independent thinking and follow other people. This leads to biases like illusion of control, herding, myopic, loss aversion, recency effect, and confirmation trap. Now, let's talk about organizational constraints. Fund managers often go with the crowd to feel safe and accepted rather than taking different financial decisions and risking their own reputation. Now, let's talk about the success of contrarian investing. First, low P contrarian portfolio versus a high P conventional portfolio. In the book Value Investing, written by Sir Parekh Parag, Sir proved that if one invested in a low P contrarian portfolio rather than a high P conventional portfolio, he will earn a higher rate of return over a long run with less risk. Now, it's a high time we take VST Industries as a case study. VST Industries was a classic example of a bloom in a desert. VST Industries was a uh, undervalued tobacco company with strong fundamentals like zero debt, high ROE, steady cash flow, and a good dividend yield. But still, market ignored this stock due to fear. Low PE ratios and a good dividend yield acts as a margin of safety while the market re-rates such stocks. Hence, VST Industries was a classic example of a contrarian investment opportunity. Now, Vedanshu will take over.
Thank you, Rayans. And now I am going to explain the concept of growth trap. In simple terms, it means paying too much money to those company who is growing fast. What is growth trap? Many investors get easily attached to high growth companies, but according to Parak Pariksa, this can be dangerous. Just because investors blindly chase those companies who showing high growth, they ignore valuation. It means they does not check whether the price is justified or not. They end up paying for the future expectation that may not come true. And as a result, even a good company can become a bad investment if they bought at high price. And one thing that every investor that remember that high growth does not always mean a good investment. Now let's come towards the behavior base. This mistake mainly happen due to human psychology. In that, it start with overconfidence. People assume that company will keep growing forever in the future. Herd mentality. People do and follow what other people are doing. Recency base. The people believe that the recent success will keep continue in future. And the last one is FOMO, which stands for fear of missing out. They buy quickly just not to miss the opportunity. And one thing that every investor remember that behavior-based factor that push investor to take emotional decision instead of taking rational one. And the core message from whole concept is price is what you pay and value is what you get. Now let's move towards the another slide. Commodity investing. Commodity investing is very different from equity investing. To understand it properly, we need to focus on cycle. Let's come towards the natural commodity asset. The commodity are the physical assets like oil, gold, and other agriculture products. Unlike stock, they do not generate earning or cash flow. Their value mainly depend upon the price movement in the market. The second one is supply demand mechanism. Commodity prices are mainly driven by global supply and demand. Any shortage of raw materials or the product that can push price up sharply, while oversupply also lead to decline. And due to that, the factor may play major role like weather, products, and geopolitics. The third one is commodity cycle. Unlike equity, commodity do not grow consistently. They move in cycle and it contains four phases: boom, recession, depression, and recovery. These cycles are mainly linked to economic expansion and contraction. Now, fourth one is volatility and risk exposure. The commodity are highly volatile and unpredictable. There is no long-term compounding benefit like in equity, and the price can fluctuate significantly due to global event and speculation. And the last one is strategic allocation approach. The commodity should not be treated as core investment. There are many better ways for the investor to diversify their investment. The successful investing in commodity mainly depend upon the timing rather than holding long term. And the one thing that every investor remember that in commodity, timing matter more than quantity. Then I would like to call Neil.
Thank you, Vedanshu. Now we will begin to learn with what is public sector units. So let me start with PSUs. PSUs are government-owned companies where the central or the state government holds more than 50% ownership. These companies are formed to operate in key industries of national importance such as energy, infrastructure, and financial services. Talking about their ownership, the majority of the shares are held by the government. Although some PSUs are listed on the stock market, the government still remains the main controlling authority. Now, looking at their characteristics, PSUs focus on both public welfare and profit. Compared to private companies, they are usually less flexible in decision making, but they are more stable and reliable. In terms of their operations, PSUs mainly work in core sectors like oil and gas, power and energy infrastructure, and financial services. These sectors are very important for countries' economic development. From an investment perspective, PSUs are often misunderstood. Many investors believe they are inefficient or slow. However, according to the book, this negative perception is often exaggerated. In reality, many PSUs have strong fundamentals and consistent good performance. Because of this gap between perception and reality, PSU stocks are often undervalued. Investors tend to ignore them due to biases, which create opportunities for smart investors who think long term. So, the key takeaway here is that PSUs may not look attractive, but they can offer a hidden value. So, now we will move towards the next slide, that is sector investing. So, sector investing is a strategy where an investor chooses a particular industry such as banking, IT, or energy, and then invest in the top companies within that sector. This approach looks very attractive for several reasons. First, certain sectors show high growth potential. Second, some sectors become popular due to market hype. And third, economic changes and government policies can further boost these sectors. However, this strategy has some major problems. The first problem, that is overvaluation. When a sector becomes popular, stock prices rise quickly, often going beyond their actual value. The second issue is herd mentality. Investors follow the crowd instead of making independent decisions. This is driven by emotions like greed and fear of missing out, that is FOMO. Another problem is that investors often ignore companies' fundamentals and focus only on the sector trend. A sector does not generate a sector does not guarantee that every company in it is a good investment. Now we will talk about the sector bubble cycle. So understanding the sector bubble cycle, which explains how this process works. It starts with excitement, where new opportunities or policies create positive buzz around the market and investors become optimistic. Then comes the boom phase, where prices rise rapidly and investors enter the market. due to the hype. After that, we reach overvaluation, where prices become too high compared to the actual value and expectations becomes unrealistic. Finally, the cycle ends with a crash, where reality does not match expectations, investors panic, and prices fall sharply. The entire cycle is driven by the human behavior and not just fundamentals. So, to conclude both the slides, I would like to say that both the chapters highlight the importance of behavioral finance. In PSUs, investors miss opportunities because of negative perception. In sector investing, investors face losses because they follow hypes and trends. If a smart investor invests in a market, he should avoid herd mentality, focus on long-term value and rational decisions instead of emotional ones. Thank you. Now, my friend Snesha will carry on.
Thank you, Neil. Hello everyone, let's start with understanding the initial public offering. Investors prioritize singular information, recent hype over historical base information, fueling excitement during bull markets. Herd behavior drives those missing IPO allotments to buy at listing premiums, chasing perceived hot stocks like Snowman IPO. Investors are not always rational and often make emotional choices. One major bias is overconfidence, where investors believe they know more than they actually do. Overconfident investors trade too frequently, reducing returns. Anchoring bias occurs when people rely too much on past prices. Investors may refuse to sell a stock because they are stuck on its old high price. Loss aversions, where means people fear losses more than they value gains. This leads to holding losing stocks too long and selling winners too easy, too early. Herd behavior is when investors follow the crowd without analysis. This often creates market bubbles and crashes. One major bias is overconfidence, where investors believe they know more than they actually do. Overconfident investors trade too frequently. Anchoring bias occurs when people rely too much on past prices. Emotional reactions like fear and greed drive many market movements. These biases lead to mispricing in the stock market. Next slide. Now let's talk about the behavior bias and smart strategies in the IPO investments. Core thesis where IPOs trap investors via hype most underperform long term 70 to 80% lag market after 3 years. Singular vs based information where hype overrides history, investors chase recent pops, ignore decades of poor IPO returns. Herding effect where failed allotments spark FOMO. Example Snowman IPO chased at 100% premium despite fading value. Novelty bias, where new allure blinds to risk, promote exit at peak via offs post lock-in. Uh, Availability bias occurs when decisions are based on recent or easily available information. Stakeholders' incentives, where companies maximize funds raised, bankers earn fees on total capital, retail overbids blindly. Value advice, where skip IPOs, buy established undervalued funds during correlation with margin of safety. Confirmation bias makes investors seek only information that supports their belief. They ignore negative signals about their investments. Availability bias occurs when decisions are based on recent or easily availability information. News and trends strongly influence such investors. Emotional reactions like fear and greed drive many market movements. Value investing require patience and long-term thinking. Investor must remain calm when markets are volatile. Next slide. Now let's talk about the index investing, where Parik sir praises indices like Sensex outperforming 90% of active funds long-term, but critiques big biases driving blind indexing. News and trends strongly influence such investors. Emotional reactions like fear and greed drive many market movements. This biases leads to mispricing in the stock market. Confirmation bias makes investors seek only information that supports their beliefs. They ignore negative signals about their investments. Investors are not always rational and often make emotional choices. It shows how market inefficiency arises due to investor biases. Value investors look for undervalued stock caused by irrational behavior. Fear-driven selling often creates buying opportunities. Overreaction to bad news can push stock prices below intrinsic value. Independent thinking is important instead of following the crowd. Contrarian investing means going against market trends. Behavior finance explains why such opportunities exist. Margin of safety is essential to reduce risk. Emotional discipline helps investors stick to their strategy. Avoiding herd mentality leads better investment choices. Successful investors control greed during bull markets. They also control fear during market crashes. Empirical data where index exited stocks often outperform entrants. Lagard's rebound post-deletion for contrarian alpha. Market cap weighting creates flaws. Firms gain inclusion by inflating caps, leading to premium pricing on on new entrants. Behavior insights improve stock selection and timing. Learning from past mistakes is crucial for improvement. Blend approach where use indexing for core stability, active bets on undervalued exclusion for superior returns. They also control fear during market crashes. Consistent analysis is more important than market noise. Now my friend Shabir will continue.
Thank you, Sneh. Now let me begin by introducing the concept of bubble trap, a critical phenomena in financial markets. Financial bubbles are not driven by logic alone; they are largely shaped by behavioral biases. Markets often oscillate between rational thinking and collective irrationality, leading investors to repeat the same mistakes despite clear historical evidences. Bubbles can emerge at multiple levels. First, market-wide bubbles where entire markets shift from rational valuation to mass hysteria. Second, sector level bubbles, often seen in industries such as IT, real estate, and infrastructure, where speculative enthusiasm drives excessive valuation. And finally, third, individual stock bubbles, where speculation or even manipulation results in unrealistic pricing. At the core of these bubbles are behavioral drivers such as greed, herd behavior, and overconfidence. Investors tend to follow the crowd, overestimate their judgment, and chasing rising prices without sufficient analysis. The bubble cycle typically follows a pattern. It begins it begins with a bull market, followed by excess euphoria, leading to formation of bubble. This eventually followed by crash and panic. Finally, a broader market correction. These dynamics create significant risk, including capital loss, liquidity risk, and sudden collapse, often leaving investors with little time to react. The key lessons here are clear. Avoid following the crowd, stay away from overvalued stock, focus on intrinsic value, and always remember that price you pay determines your return, not merely the quality of assets. Next slide. Now let's move on to the investor behavior-based finance, which focuses on how investor psychology directly influences market outcomes. Understanding investor behavior is essential because it shapes stock prices, corporate strategies, and overall market dynamics. Despite this, companies rarely invest enough effort in studying their investors. A structured approach to understanding investor includes four key steps. First, identify key investors. Second, assess their investment horizon and decision-making patterns. Third, analyzing trading behavior. And finally, map and communicate these insights effectively within the organization. Investor behavior also plays a significant role in ESG impact. It influences stock prices through market performance and shareholders' value, shapes investor sentiment through confidence and preferences, and drive corporate impact, including sustainability initiative and risk management practices. Another important concept is behavioral valuation. During the market booms, assets are often overvalued due to optimism and speculation. Conversely, during periods of pessimism, assets may become overvalued, creating opportunities for disciplined investors. Markets are often inefficient because they are driven by emotions rather than pure fundamentals. This results in volatility, overreaction, and mispricing between intrinsic value and market price. From strategic perspective, organizations should focus on understanding their investors, aligning their strategies with investor psychology, and building a long-term relationship and trust. The key lessons here are to avoid market noise, focus on intrinsic value, and develop a deep understanding of behavioral biases. Next slide. Now, to synthesize this concept into actionable intelligence, let's look at our in a nutshell framework. Value investing emphasizes intrinsic value, patience, and long-term discipline over short-term market fluctuation. Success in investing depends more on emotional control than intelligence. Avoiding greed, impulsiveness, and poor decision making is critical for sustainable returns. Although market may appear volatile, they are fundamentally stable. Much of volatility arises from speculation and crowd psychology rather than actual business performance. A key principle to remember is that returns depends on price paid. Buying undervalued asset with patience can lead to significant long-term compounding gains. Behavioral biases such as herd mentality, overconfidence, and FOMO, fear of missing out, often result in poor investment decisions. Growth investing can become risky when investors overpay, leading to what is known as a growth trap, where even fundamental strong companies become poor investors due to excessive valuations. Commodity investing is cyclical and volatile, making it more suitable for diversification rather than core investment strategies. Similarly, sector investing often follows a bubble cycle, starting with excitement, moving to boom, leading to overvaluation, and eventually ending in crash. Additionally, IPOs and index investing can exhibit inefficiencies due to hype and structural biases. These inefficiencies create opportunities for disciplined contrarian investor. Now, in the end, I would like to conclude that long-term investment success requires avoiding crowd behavior, focusing on intrinsic value, maintaining a margin of safety, and thinking independently with patience and discipline. Thank you.